We have a little bit of a rally on our hands to end this week. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, earnings season is in high gear. We're going to take a look under the hood of Fifth Third Bank with CEO Tim Spence the next hour.
And Netflix is winning the subscriber battle, blowing past Wall Street targets on every major metric. We'll have full analysis for you.
And changes at the top for CVS. The struggling pharma giant ousts its CEO and reports disappointing third quarter profits. All of that and more coming up. But let's take a look at where markets are trading 30 minutes until those bells ring. And as Matt said, a little bit of a rally here. The S&P 500 was unchanged at the close yesterday. Now ahead of the open, up by about 0.2%, looking to end the week on a high note. Big tech leading once again. Of course, it's been really volatile, but we did have those Netflix earnings surprising to the upside. The Nasdaq 100 higher by about 0.6%. Pretty quiet in the bond market for now, but we have seen quite a sell-off. Of course, that 10-year yield now back to about 4.08%, but currently unchanged at this moment, Matt.
All right, yesterday we had some pretty amazing economic data in this show. We told you about retail sales blowing past expectations as well. That leads to a much stronger economy. And to that note, I have here the Atlanta GDP Now forecast, or Nowcast, as they cornily call it. You can see right now we're running at a GDP pace of 3.4%. So with a huge gain like that, you have to wonder, are we going to get any more Fed rate cuts this year?
It's certainly a big question underpinning the market. Some more things, Matt, underpinning the market. Some stocks to watch. Lamb Weston, lower after a report that activist investor Jana Partners built a stake of roughly 5% in the struggling French fry maker. Sorry, it's higher now by almost 9%. Just stunning. They might look to push for a sale, and investors are looking out for that in a year where a lot of activism is underway. We're also looking at Netflix after reporting more than 5 million new subscribers in the third quarter and a strong forecast. Netflix now up another 6.6% pre-market. Just stunning after the rally we've seen this year. CVS Health, though, down now almost 8%. CVS named David Joyner as its new CEO. The company's exploring options to break up its pharmacy and insurance businesses. Matt, a lot of M&A under this market.
Yeah, a lot of breaking news this morning to kick off the show. We had the American French fry maker news with Lamb Weston. You had the CVS ouster that, you've been so focused on the drugstore chain. And we're focused in on, obviously, Netflix driving shares higher with its earnings. And we're going to talk to also the CEO of JCPenney.
A lot to look forward here, too. Also, did you mention, of course, Spirit Aerosystem? Because that was a big one coming from Reuters. You think about the ripple effects of that Boeing strike. It's not just Boeing. You have Spirit Aerosystem furloughing workers due to the Boeing strike, warning that they may have to lay off workers if those strikes persist. So a lot to keep an eye on here. But let's talk a little bit more about CVS and that CEO shakeup. We'll do that with Bloomberg's healthcare reporter, John Tozzi. And John, it's really interesting. Of course, typically when you see a change like this for a chain that's struggling, you see a little bit of a positive reaction in the shares. But as Sonali pointed out, you have shares of CVS quite lower right now, of course, down to the tune of almost 8%. And John, I guess that underscores the severity of the problems that CVS is facing right now.
Well, yeah, I mean, along with the new CEO announcement, the company sort of did a preliminary release of their third quarter earnings, which missed Wall Street's estimates. And they also pulled their 2024 guidance. That guidance had been revised downward over and over and over again this year. And the company said basically that the forecast they issued in August is no longer operative because of runaway medical costs in their health insurance business.
I'm wondering also, this new CEO, how much of a fix is this? You know, in a memo to employees, he said he needs their help. It's no secret that the industry faces significant dynamic challenges. CVS must make financial and operational improvements. This is a guy that came back from retirement a couple of years ago to help this company navigate the storm. He's 6 years old at this juncture. Is this a complete fix to just change the top of the firm at this juncture?
I mean, I think, CVS has a lot of challenges ahead, regardless of who is in charge. There's the retail drugstore business that is pretty well known. That's under pressure from, Amazon, Walmart, kind of seeing the same sort of struggles that all retailers are. It's got a large pharmacy benefits management business that's facing kind of increasing scrutiny in Washington. They were sued by the Federal Trade Commission recently, along with some of their competitors. But the real problems, or the main problems at CVS are coming from the health insurance business, Aetna, which it merged with several years ago. That's where the now former CEO, Karen Lynch, came from. And basically, Aetna, particularly its Medicare plans for older Americans, is facing just much higher costs than they expected, higher medical expenses. There's a sense that something, in their projections or their modeling really went wrong, and the company's been paying the price for that.
Hey, John, CVS has done very poorly over the past year, over the past 5 years. It hasn't done nearly as badly as Walgreens, Boots, Alliance. Is one of the problems just the stores? They're drugstore chains, so dirty, so disorderly. Everything has to be locked up. It's a really horrible shopping experience, no matter which brand. What's wrong with this industry?
Yeah, I mean, I think, probably like you see across retail, like we said, pressure from more online shopping, Amazon in particular, and then, the larger kind of Walmart stores, has left retailers like CVS, like Walgreens in a really bad spot. They've tried to pivot to healthcare. CVS has a long, besides just being a pharmacy, they've got a long history in, pharmacy benefits sold to employers and health plans, and then with the Aetna merger, more broadly health benefits. And they made some acquisitions under Karen Lynch, purchased Oak Street Health, Signify Health. These are sort of care delivery clinical businesses meant to have some kind of synergies with the health insurer. But this is all kind of, these are legacy retailers that are trying to become more and more healthcare enterprises. And it's a hard pivot to make.
John, great to have some insight from you. Thanks so much for joining us. John Tozzi there covers healthcare and the costs associated. I feel like they just need to get somebody to mop up. They need to go in there with a mop and just clean the store.
Unlock the cabinets.
The whole store.
Yeah, no, both of them, because it's a good point. I mean, there's plenty of CVS's in the city that could use some cleaning. But I'm glad you brought up the shares. One of our producers, Dan Curtis, points out that if you take a look at the C-suite since at least 1999, Karen Lynch is the only CVS CEO to leave with the stock lower than where it started. And that, a real-time report card, not so hot.
Absolutely brutal. Another brutal stat here is that Aetna deal was almost $70 billion when it was announced in 2017. To unravel that would just be a massively failed M&A strategy. And by the way, guys, they're not the only ones suffering that pain right now across corporate America.
Well, they're only worth $80 billion in total. So it doesn't look good for that merger in hindsight. Meanwhile, Netflix, it does look good there. The shares are even higher again after beating expectations on every key metric, including, importantly, subscriber additions, as well as providing a positive forecast. Madison and Wall principal Brian Wieser joins us to talk about this. Everybody's been saying for a long time they can't just keep cracking down on password sharing. That's not going to continue to drive subscriber growth, and yet they added another 5+ million. Brian, what's going on?
Well, first of all, I think there's so much room to run still for them, and frankly, for anyone else who invests as much as they do in content, because that is the driver here. In the United States, there's like $140 billion spent on video services in the United States. They're just barely cracking the surface of that.
Yeah, it's amazing. And you think about some of the fears heading into this report that maybe Netflix was past its peak when it comes to sales growth. Clearly, some of those fears unfounded. Talk to us about the competitive landscape here when it comes to streaming, because it feels like Netflix's world, basically, and we're all in it.
Yeah, and it's still so surprising. The strategy Disney had back in 2018 was the right one. Invest a lot, go global, go big, or go home. Turns out that most of the others basically went home, or they stopped investing. They stopped trying to build these big global platforms. They got afraid because of the cost. But the fact is that if you want to get to a mid-20s margin and you want to have 15% revenue growth, guess what? You need to be spending more than $10 billion a year on content.
I was just going to ask you about the spend here. How much are you comfortable with Netflix spending, particularly with all the excitement around some of the newer areas they're looking into?
Yeah, well, listen, I think it's theirs to take. So I think if they want to keep growing their business, more spending on content will result in more revenue because they will add more subs, they'll have more pricing power. So I don't think it's a problem. I really don't see any limits on that front. I think the more interesting thing is just asking, why don't the others follow the playbook?
Well, can they make money on advertising? Because it doesn't seem like they've really turned that around yet. And there's a couple of other things it looks like they need to execute on over at Netflix. Beyond the crackdown on password sharing, what's your estimate for how well they can do on these sort of new tech things?
Yeah, absolutely. The advertising piece is actually what we spend most of our time trying to understand and focus in the broader scheme of the industry. Here, they haven't built a very big business yet. And it's really hard because if right now on estimates, probably around 12% of US subs and maybe something similar global. I mean, yes, they're getting 50% of new signups, but because of churn, you can calculate some number around that. That's not a very large number, unfortunately, for what television-based advertisers tend to want. And so it's still very small, for lack of a better word. That doesn't mean it's not helping them broaden their subscriber base, which is kind of the point. But it's not that big a business yet, and it might not ever be terribly massive.
That's a really interesting point, and I'm glad we're talking globally here because, as you mentioned, two regions, Europe, the Middle East, and Africa, also the Asia Pacific, accounted for almost half of the new customers. Netflix did lose customers in Latin America for the first time since early 2023. But are you saying, I mean, on the subscriber base, they're growing subscribers, that's good news, but are you saying that when it comes to advertisers, they're not necessarily excited by those numbers?
Well, I think that there are individual advertisers who are very excited about being associated with the content that Netflix has. But in aggregate, it's not like a lot of money because if they're only doing $500 million or $1 billion of revenue, that's relatively small in the grand scheme of things of the television industry. Now, that might be great for Netflix. It's a nice incremental side hustle, so to speak, but it's not going to be core anytime soon. You're right to hit on the Europe thing, though, because I think that they've got a huge opportunity as they continue to invest while others fail to do so.
Going back to something Matt was asking and kind of this point on how much you're going to spend for content here, advertising revenue. You look around the corner and the idea that NFL games are around the corner, WWE programming, do you think that they have some more upside here with what they could bring in ad revenue given kind of those marquee sporting events?
Yeah, but actually, similarly, they need to invest even more in content if they want to see a meaningful advertising platform, if you will. Now, that can actually do well. The NFL, I think, will do very well because basically everybody on the service will have access to that content, and therefore they'll have much broader reach. But at the same time, if it's just a small number of games, a relatively limited amount of inventory, it's hard to do anything with that as a marketer. So again, you need to go big or go home. You need to have like a full schedule of sports. You need to have the capacity to satisfy the entirety of a campaign, essentially. And they're a long way from being able to do that right now.
All right. Brian, thanks so much for joining us. Madison and Wall Principal Brian Wieser talking us through Netflix. We didn't really touch on video games, And I mean, obviously, none of us is playing video games.
How do you know I'm not?
I mean, you're at work all the time. When would you possibly do it?
All right. I play at night. We don't know. Anyways, coming up, we're going to talk about stars and business leaders generating at the Al Smith dinner. They've gathered last night in New York, but only one of the candidates for the White House showed up. We're going to talk about that in high interest next. This is Bloomberg.
All right, a quick check on futures, of course. Less than 15 minutes until the bells ring. You can see a little bit of life back in this market. The S&P 500 up 0.3%. Big tech is your leader, up 0.7%, but small caps putting up a fight as well, currently higher by about 0.5%. Let's broaden out this conversation with Jason Draho. He is UBS Global Wealth Management Head of Asset Allocation Americas, joining us on set on this Friday morning. It's great to see you, Jason.
It's great to be here.
I go to the first line in your notes. You say that recent data points towards a no landing scenario. What does no landing mean to you, and how do you position for it?
So there's a lot of terms, soft landing, no landing. I like to try and quantify it, and I kind of call it the 5% landing. By that I mean like the nominal growth rate in the U.S. economy for the first half of this year was 5%. It's tracking to be 5% in the third quarter. We think about last year was 6%. I think of like we've landed, and this is kind of like the landing spot. So when we debate soft landing, hard landing, I think this is kind of what we are. It's not clear why the economy would slow much, and it's been at this pace for a while. So this, to me, that's how I think of it in terms of quantitative perspective, about a 5% nominal growth rate.
If I count on higher growth, that means I can kind of count out more Fed rate cuts, right? We're adding jobs. Inflation is still 3.2% at the core. We're looking at 5% growth, which is a very high number, I think, but that doesn't seem good for, especially not good for small caps.
So it depends. Like small caps could benefit from, an economic expansion that looks like it's going to go longer. So I think when you see small caps performance this year, it's often been tied to rate cuts, but it's really the expectations. Will we have this extended sort of elongated cycle? If that happens, I think you can get small cap, like a sustained rotation.
Check out this chart, by the way. I kind of stole this from Torsten Slok. The white line here is members of the Russell 2000 that are losing money. That's trending higher. Yeah. So they're going to have to keep borrowing money at higher interest rates.
So look, if rates stay high because the economy is stronger in some way, that doesn't help small caps. I think that's one of the reasons why investors have been reluctant to do anything more than a kind of a quick rotation. We saw that in the summer. In 3 weeks, small outperformed large by 12% in 3 weeks, and then they've kind of pulled back. So to me, right now it's more of a trade as opposed to sustained performance for small caps.
Well, to that end, how strong does growth really need to be to sustain the overall rally in the S&P 500 as well? Because, you look at the third quarter, expectations are kind of muted, but they ramp up for earnings very meaningfully into the fourth quarter and into next year.
4% for this quarter, 14% for next quarter, 14% for the following quarter.
Well, for equities, ultimately, valuations for the S&P overall, they're rich. So we think it's going to be earnings growth that's going to drive the story. If you get strong nominal earnings or strong nominal GDP growth, you're going to get good revenue growth, you get earnings growth. We're looking around 8 or 9% next year. That's kind of the key driver. So valuations can stay where they are, but if you get the earnings growth because a good economy, stocks, we think will still continue to go higher over the next 12 months.
There's 18 days until the presidential election, and you were talking about how small caps maybe look like a trade here. I want to talk about the Trump trade because there was a really interesting note out from Bank of America that says that the performance that you're seeing in the past week in banks, small cap stocks, and the dollar are sort of front running what we saw in 2016. I mean, banks, you could make a case of they all just reported blowout earnings, so that might be a coincidence. But I'm curious, from your seat, are you seeing evidence that this market believes that Trump will win?
There's certainly things like if you look at baskets of stocks that are sort of Trump baskets versus Harris baskets, there's definitely been some movement there. In terms of rates, for example, or the dollar, I think that's more a reflection of just strong economic activity. So trying to disentangle the two, it feels like I'd rely on more of the economic data as being the driver. The Trump probabilities, at the margin helps, but to me, that's not the catalyst. It's the data that's the catalyst for moving the markets.
There's a great chart here Dan Curtis put together. We have a basket of stocks that that should benefit from Republican policies here in red, and a basket that should benefit from Democratic policies here in blue. You heard John Micklethwait talking about this when he was interviewing Trump in Chicago the other day. The market looks like it's leaning into a Trump presidency.
Well, certainly the prediction markets have shifted in that direction. Now there's questions about how valid is that data, who's
on
in
that
it.
note.
Big question.
Big question.
Great story from the Wall Street Journal on that topic this morning, actually.
Saying what? Saying that,
basically
Republicans are pouring money in to predict it?
You have these big whales in the betting markets that can shift things around with just like $30 million, which is not nothing, but it's not a lot.
But are those whales in the stock market as well? And how long do these trades last for? Are they simply trades, and do they unwind, frankly, after the election?
Well, it depends on the exact outcome of the election. Depends upon the makeup of Congress. To me, the direction of travel for the markets is still going to come down to what is the economic data and what is the Fed. So in a matter of, 4 business days, we have October payrolls report on a Friday, the election on Tuesday, the Fed meeting on Wednesday. So I think ultimately the payrolls report and the Fed long term, that's going to be the key story, more so than the election outcome in terms of where the market's going to be, not 2 weeks from now or 2 weeks after the election, but like 6 months from now.
Jason, yep, go ahead.
I don't think 30 million, I hope 30 million isn't going to move the stock market. That would be amazing.
Well, that's what I'm saying. I don't think that there's massive trades in these Trump trades like there are maybe in the betting
markets. That's a good point. I can see how it would be helpful to a political party to have someone go and skew betting markets, right? Mm-hmm. But you can't do that in the stock market.
No, you need to have some.
Although maybe in DJT.
Maybe that's, liquidity there. It's a question mark. Jason, it's great to see you.
Thank you so much for coming in. Of course, that is Jason Draho. He is of UBS Wealth. And coming up, we're going to talk about Tesla's self-driving system under federal investigation. We're going to bring those details to you in Social Climbers next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Intuitive Surgical beating third quarter results. The strong quarter getting boosted by orders of the Da Vinci 5. It's a surgical robot that makes it easier for surgeons to understand body movements during operations. Next up, the U.S. is opening a federal investigation into whether Tesla's self-driving system is defective after a series of crashes, one of which resulted in a fatality. Shares down slightly here. And let's end with Procter & Gamble is posting a second straight quarter of sluggish sales growth, dragged down by weakness in skin and baby care. Shares currently off by about 2%. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. All right, a check on these markets. Of course, minutes to go until the bells ring. A lift on this Friday morning across the board here. You can see big tech is your leader, but those small caps putting up a fight, currently higher by about 0.4%. Now, with less than 4 minutes until the opening bell, we'll discuss all of what's going on in the market with Nancy Tengler. That conversation coming up next. This is Bloomberg.
All right, we just have 23, 22, 21, 20 seconds until the opening bell. We're looking at futures that are higher on this Friday, although yesterday we saw some gains around this time and they dissipated into unch at the close. Nonetheless, about 0.25% higher on the S&P, more than 0.5% higher on NASDAQ futures. Of course, you'll see tech and really communications, because that's what we call Netflix, driving markets higher, at least at the open. You hear the opening bell, and Clean Core Solutions ringing it down to the New York Stock Exchange. At the NASDAQ, you've got Camp 4 and kids, which is nice, getting them into financial markets young. Can we hold on to these gains into the close and hit another record high on the S&P 500? Katie Greifeld, that would be what, the 48th this year?
Something like that. High 40s, that's where we're standing. And 28 seconds into the session, it looks pretty good. If we stay around these levels, if we stay green, this would be the 6th straight week of gains for the S&P 500. Certainly feels like a while since we've seen that. And that index currently up about 0.3%. Big tech having an even better time, currently higher by about 0.6%. Of course, we got that knockout from Netflix last night, certainly helping the big tech benchmark. Then you take a look at the small caps, also having a good start to this Friday morning, higher by about 0.3% on the Russell 2000. Meanwhile, you take a look under the hood, and we found some bad news. It's CVS, of course, naming David Joyner as its new CEO, ending a tumultuous tenure for Karen Lynch at the pharmacy giant as it explores options to break up the business. Of course, it also came out with its results rather early. They weren't good, withdrawing guidance as well. Just a lot of issues facing CVS. You add it all together, and shares are down about 7%, Sonali.
Also, Katie, I'm taking a look at Lamb Weston because activism has been a huge story in this market. And Lamb Weston is moving on a report that activist investor Jana Partners has built a stake of roughly 5% in the struggling French fry maker. It will push for a sale. Lamb Weston now up 9.2% at the market open, Matt.
All right, let's take a look at Netflix as well. After the streamer added more than 5 million customers in the third quarter and topped Wall Street's estimates on just about every major financial metric. We want to talk about these moves and really focus in, I think, on the chip sector with Nancy Tengler. She joins us now from Laffer Tengler Investments, where she is CIO and CEO. Nancy, it's great to have you after a week of really volatile news from the chip makers, right? We got disappointing, hugely disappointing orders from ASML, and then TSMC knocked the ball out of the park. A lot of acronyms there. We can go through them if you like. But Our takeaway was simply that it's a bifurcated world. There's a real dichotomy in terms of chip makers. Pick your 50-cent word. What do you like in this space, and how reliable are they, or is it always going to be a volatile area?
Well, thanks so much for having me, Matt. I think that you have to stay with the AI chip providers. I mean, that's just where we are in the cycle. We know that Blackwell has, and that's an NVIDIA chip, has a 12-month backlog. We know that the demand remains strong. And so really, if you look at the names that we own, our largest holding is Broadcom. It has been for quite some time in the chip space. And we think that can continue to outperform. Great capital allocation program to shareholders. So the dividend growth has historically been really strong, not so much just recently, but we think that reaccelerates. And then share buybacks. But also, it's a company that is coexisting and complementing NVIDIA, not competing with them. And then on the competition side, we own AMD. We also own NVIDIA, but we own AMD just for the table scraps. I mean, that's all they need. With the backlog so high, that they just, people will buy their chips, and it will drive revenue growth, even if the chips aren't quite as good. They had kind of an underwhelming product launch recently, but we think that just provides an opportunity for investors to add to holdings. So those are our three largest, and then we own NXPI and Texas Instruments in our dividend growth strategies. But I think you want to be exposed to AI still and for a while longer.
Well, I love that. When it comes to AMD, they're just competing for crumbs here. That's a pretty good way to phrase it. You take a look at share performance year to date. AMD only higher by about 6%. You take a look at NVIDIA, for example, higher by about 179%. So quite the dichotomy there. You would think that, of course, NVIDIA's crumbs would be better than 6% year to date performance.
Yeah, we picked it off, Katie, in the summer when everything during the tech swoon, the annual summer tech swoon, and so we're pretty happy with where we got in. But I think you have to be aware that the industry leaders are going to continue to drive this market. With they've got fortress balance sheets. Their earnings growth is reliable and appealing, and so they've become, in many cases, the new defensives as we thought we were moving into a slowing economic environment. But it turns out that may not be the case, with GDP now just getting revised up to 3.4% for the third quarter. So I think you still want to be exposed. It's not necessarily the Mag 7. But last thing I'll say on that is, if we hear a lot about valuations and how they're stretched, but in the 90s, and I've been drawing that analogy for a couple of years, that this market and economy is analogous to the 90s. We had, of the 50 largest companies, we had 12 that were trading over 50 times, and the average multiple for the top 50 was like 45.3. Today we have 3 trading over estimated earnings of 50 times estimated earnings, and the average multiple for the group is 24.8. So I think you let productivity drive this market and the growth, and you participate by owning the names that are contributing to that.
Nancy, chips, AI are certainly a hot story in this market. But when I look at today, we look at the single name stories, activists in Lamb Weston, breakup potentially at CVS. You're looking at these real economy names that seem to be going through either transformations or flat out struggling. And if you're an investor today, how do you navigate that? And why do you think this is the case when all you hear is about how strong this economy still has held up?
That's a great question, Sonali. We owned CVS years ago, and we did our work. And even though Karen Lynch is an appealing individual and I think did her best as the CEO, the business model is just broken. And so we got out a while ago, just as we did with Intel. Now, we don't always get them right. I mean, we've owned some stinkers, but you have to, I think, stay with the great management teams, the industry leaders, that if they don't have the technology, they can buy it, and really embrace our investing theme, because we think it's the right one, which is old economy companies that are pivoting, and then the suppliers of the picks and shovels and the infrastructure. But you need companies to be embracing the new technologies. Walmart's our poster child, but there's plenty. Even American Express is embracing utilizing generative AI to improve fraud detection. So they had great earnings. I don't know why the stock's down, but I think it's an opportunity if you're a long-term investor.
I'm sure I've asked you this before. We've talked about the comparisons to 1999, but do you have a playbook from that period? Because I'm sure around then people were saying very similar things about Cisco. You know, they were selling the picks and shovels for the internet, and for a long time it was a killer investment, and it looked like you know, order growth would never slow. Of course, after a while, you know, it became expensive to lay down fiber for every mile. So what do you think about using your experience from then in this revolution?
Perfect question. Yeah. So my analogy is not to 1999. It's to the mid 90s when you had so many similarities from an economic standpoint, and a Fed that navigated a soft landing, an inverted yield curve, geopolitical tension. We could go on and on. But what I think you need to pay attention to is that these companies have much more robust earnings growth. It's broader, they're stronger, they're bigger companies than we saw then. I mean, Cisco ultimately failed in terms of earnings growth because the companies that they were supplying to went out of business. So this is not that, but I still think you have to be careful. So you really want to own companies that have attractive valuations, not excessive valuations, but you also want to strap in for the growth. So I know that's not a very clear answer, Matt, but you just need to be vigilant, pay attention, and look for bubbles. I just don't see it because we're in an environment where these companies are not only growing, but they have humongous cash balances on their balance sheet, so they can navigate the problems pretty effectively.
All right, Nancy, it is always a joy to speak with you, especially on these single stock names, of course. Great commentary on the chips names that we've been talking about all week. That is Nancy Tengler joining us from Laffer Tengler Investments. Meanwhile, let's take a closer look at the other big movers to watch. We're going to do that with Bloomberg's Abigail Doolittle.
In fact, Katie, let's take a look ahead at earnings for next week, because it's going to be a big week. About $8 trillion worth of market cap and companies reporting, and you can see some big names on this board. Boeing reports on Wednesday, and of course, this will be the debut of CEO Kelly Ortberg. They essentially pre-announced to be able to file that $25 billion equity shelf, but we will get more color on that call, which should certainly be interesting. And then, of course, UPS, there's the expectation that this quarter that they're going to report on Thursday could be the first quarter in 7 where they actually report growth as opposed to a decline. And then Tesla on Wednesday, more color on the robo-taxi. But this next week, while it is $8 trillion, it's the week after that's really the big tech week with even more market cap reporting. Specifically, $23.5 trillion worth of market cap will be reporting that following week, October 28th, and then it trickles off, although we always joke that it feels like it's always earnings season, and this is largely why. There will be companies after those 2 big weeks. And then finally, when we just take a look at the performance of some of the companies that perform next week, interestingly, I don't know if all of you can remember it, when GE, I think, was single digits a few years ago before the big turnaround of Larry Culp. This year, up 89%. Boeing, on the other hand, down 44%.
Breaking up is hard to do, but it certainly can bring riches.
By the way, Katie is not joking when she says it's always earnings season.
I'm not. It's not a joke. I'm being 100% serious.
Yeah. Do you both say it? Because I feel like there should be a set time and...
Yeah, but I started as a currencies reporter, and then I started expanding out a few years ago, and I was like, wait, we're always in earnings season. This never ends. We always talk about the unofficial start, the unofficial finish. It's just constant.
But some weeks are bigger than others. Next week bigger than this week. The week after that, the biggest of the weeks, at least for this season.
And then we fall off mightily.
Yes, I sure hope so, actually. Abigail, we thank you so very much for your time. And coming up, we're going to look at the China rise of EV maker BYD. The U.S. auto industry is terrified, and we're going to bring you those details next. This is Bloomberg.
All All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Wells Fargo upgrading Albertsons to a buy. The firm sees compelling opportunity in the beaten down food retailer. Next up, Needham is downgrading Boston Scientific, saying that the medical device maker is no longer a buy thanks to slowing revenue growth next year. And finally, T-Mobile no longer a buy, according to Scotiabank. The firm downgrading the telecom company to a neutral, with the analyst saying that the short-term upside is limited and is awaiting a better entry point, Matt.
All right, Chinese automaker BYD has been able to churn out affordable, if kind of plasticky, EVs more efficiently than any competitor, and rivals see it as an industry killer. That's the topic of the Bloomberg Big Take. Bloomberg's Gabby Coppola co-wrote the story and joins us now. Sorry, about the plasticky comment. I was just reading a note from Data Trek because Nick Colas writes about this as well. A lot more people are noticing, Gabby, that the Chinese car makers pose a real threat to not only the European industry, but possibly even U.S. car makers. How did you see it?
I agree. I mean, and when we say U.S. car makers, remember, these are supposed to be global automakers with a presence all over the world. And, you know, we've seen this past year, you know, not just Germans like Volkswagen or Mercedes or BMW, but also GM or, you know, Toyota, Hyundai. They're all suffering very much in China, which is the Chinese, you know, which is the biggest car market in the world. But that used to be a China problem. It's not anymore. The Chinese car companies are expanding. You know, there's a big push by the government. You know, the Chinese economy is not doing well, and they really want to lean into their exports. And I think one of the bright spots in the Chinese economy is their auto industry, electric vehicles. And BYD, you know, which I wrote about with Danny Lee, is kind of at the forefront of that.
Gabby, maybe expand on just that. You were saying it used to be just a problem when it came to China, and now it's becoming a bigger problem elsewhere across the globe. If the U.S., if the European automakers can't keep up, what's at stake here?
I mean, the analogy that I've heard people say that feels right to me is a melting ice cube. You know, what is your market share? If you're a global automaker and you're getting undercut, if you're a Toyota, you're losing share in Thailand. You know, Stellantis is, I mean, BYD is flooding the Brazilian market. You know, that's a 2 million vehicle a year market. BYD is taking share there. So I think if you have a shrinking revenue base, but you still have to do all the same very expensive investments to invest in new technology, to build new cars. They've got, you know, the auto industry is also going through this really big disruption, not just electrification, but software-defined vehicles. You know, that was a big takeaway from the Beijing Auto Show this year. You saw Mary Barra, the CEO of GM, went to the Beijing Auto Show. You saw the leaders of Porsche, you know, a lot of the German automakers, and everybody was kind of just stunned at how good the Chinese cars were. And it's because it's not even just, one of my colleagues wrote a story this week about how the German automakers are viewed in China. And the lead quote was such a killer. It was a Chinese woman consumer with a lot of, you know, disposable income who had bought a Taycan, an electric Porsche. And she said, the software was not good. It was just an electric Porsche. Like, that was like not good enough anymore. You know, now given the Chinese market is different, it's really very tech focused, and it's, you know, we're not quite there in the US, I think. And the automakers are trying mightily to catch up to that. But that's the biggest car market in the world. That's what's setting the bar for technology around the world. So the rest of the auto industry now has to try to catch up if they want to remain competitive.
Gabby, great story. I highly recommend that anybody with a Bloomberg terminal check out NI Big Take to find it. You can also find it, obviously, on Bloomberg.com. Bloomberg's Gabriella Coppola co-wrote the story about Chinese car makers posing a huge threat to all of the incumbent competitors. And like I said, Data Trek wrote a note about it today as well. They went to the Paris Auto Show and checked it out. Nick Colas has a history of covering automakers in Europe. He was there in the 90s talking to them when they were only making internal combustion engines. And they said the stands for Chinese car makers were mobbed. Everybody wanted to get a piece of those.
You know, we should just have him on the show. We've brought him up like 5 times this week. Let's just book him.
It's true. Okay. Nick, please come on the show.
Yeah,
no, I'll email him.
But you know, in all reality, too, here, you look at the automakers, and they are, you know, to your point, the margins are royally different when you look across the U.S. landscape alone. And you have to wonder, you know, there's a lot of complaints about the infrastructure for EVs in America.
True.
This is a broader problem, and, you know, these are kind of national treasures, are they not?
Yeah, no, absolutely. The infrastructure piece is a tough one to deal with because no car maker wants to pay for it individually. The gas stations don't want to give up the real estate. And the federal government isn't historically good at executing.
Spending money?
No.
They're good at spending money.
Well,
just
range
not good at
anxiety
executing.
is real. I mean, when it comes to the charging infrastructure, I mean, I don't know how you get past that unless that is solved. I think that's keeping a lot of people back.
Well, speaking of spending money, we're going to talk about who's spending money up next. We're going to look at the health of the U.S. consumer. We're going to look at American Express. We're going to look at Ally Financial. We're going to look at the stocks and exactly what is bothering investors today. They're both down on the day. We're going to give you takeaways on today's Wall Street Beat. That's next. This is Bloomberg. And it's time now for the Wall Street Beat. Today we're looking at the credit card companies, Ally Financial, American Express, reporting earnings before the bell today, but both stocks are in the red. Joining us now is Bloomberg's Catherine Doherty, and I want to start with you on Amex, down more than 5% this morning. And it's interesting because Amex has really held up, that high net worth consumer, gold and platinum cards. Why the sour tone today? We had Nancy Tengler on saying she would buy this dip, but investors aren't that convinced.
So there's two reasons for the reaction that we're seeing today in the market, which is that the company had to talk about their marketing spend, which was elevated much more than analysts expected. So they're still continuing to, they're making money, but also the expenses that they're seeing to get new consumers is on the rise. And then the second is their full year revenue outlook had trimmed slightly, but I think that is being perceived as a big negative across the market. And so despite them saying that spending is still elevated with their higher end consumers, they're also, there's a note of caution in that too. So they're saying that while spending is up, discretionary spending, that folks are being a little bit more cautious in how they're spending and what they're spending on. So while the numbers are still elevated, especially compared to pre-pandemic, that there's a little bit of a question mark to what the future holds.
And it's interesting to see this reaction in shares because Bloomberg actually spoke to the CEO today. Caroline Hyde had a pen and paper with him. And you really have to squint.
She had a pen and paper with him? They shared a pen and paper together?
Pen and paper conversation.
Yes, it's a style of interview. But anyway, so they had this conversation, and it was pretty interesting. You have to squint to find any caution in terms of what he said. He said, quote, "We see nothing wrong with the fourth quarter." He's talking about the 10 consecutive quarters of record revenue. Again, we had a really good quarter, all in there. So didn't exactly see that, again, coming from the CEO.
I do think it's more about the full year. So they are saying that this quarter was strong and that they expect that next quarter will also be strong, but it's the full year. It's not as strong, I think, as what the street was expecting for 2024.
Really quickly here, Ally Financial also down today. They had previously guided, big warning sign to the industry here, that they're worried about lower middle income consumers, how they're dealing with inflation.
And it's also all about auto lending for them. And I think that is what the street is looking at today. So they're signaling that charge-offs for auto loans were higher. And as a result of that, they're pulling back. They're not writing as many auto loans. And so because of that, what the future might bring, they're saying that the reason that they're pulling back is they don't want to see as much of a loss on these auto loans. So the charge-offs, they're saying, are not going to be as much of a problem in the future. But again, that's pulling back on business that they would have previously guided to being higher.
Catherine Doherty, thanks very much for joining us. Was this a pen and paper? Was this?
No, this is a live television interview.
Ah, that's what you call this. Okay. We're going to get a read on the consumer, another read on the consumer, maybe at the slightly lower, and we talk to the CEO of JCPenney. Marc Rosen joins us in the next hour. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, earnings season in high gear. We're going to look under the hood of the real economy with Fifth Third Bank CEO Tim Spence a little later this hour.
And there are 2 weeks left until Election Day. Both candidates making a big push in Michigan. The latest on the race to the White House.
And taking the pulse of the middle-class consumer. We'll have a conversation with JCPenney CEO Marc Rosen in just a few minutes. Before we get there, let's take a look at markets right now. Of course, we are 30 minutes into the trading day. You're taking a look at the benchmarks there. The S&P 500 currently higher by about 0.1%. But I want to drill down into it because the two biggest stories of the day on the single stock level are also your biggest movers. If you take a look at Netflix, shares higher by nearly 10%. Of course, hopefully we can get that up there. They reported earnings yesterday after the bell. Great report there. And then you take a look at what's not doing well. You have CVS on the downside. Would be great to show that too. Currently off by about 7.2%.
In the terminal, if you just type SPX index move,
yes,
you get a great layout of that. Netflix, the biggest gainer, as you pointed out in percentage terms. CVS, the biggest loser in percentage terms. If you switch over to points,
you can do that.
You can see that Apple's the biggest gainer, but Amex is the biggest loser in points, which I think is really interesting considering some of the beats that they put out this morning.
Absolutely. We were just talking about that.
Yeah.
All right.
We're just repeating it. For those of you just tuning in, check out the move function. There you go. Joining us now is Katerina Simonetti, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. Katerina, we're talking a lot about the consumer today. Yesterday, we got a great retail number out, pushing the Atlanta Fed's GDP nowcast number higher, 3.4% and change. We've had great jobs numbers. The economy looks to be firing on all cylinders. Do you really expect the Fed to still cut at each of the next couple of meetings?
Well, Matt, thank you for having me on the show. Consumers are definitely under pressure despite of the numbers. One data point that we need to pay attention to is the fact that they're starting to run out of excess savings and how much pressure the high interest rate environment we have been in, plus the fact that mortgage rates are coming down but not quick enough and that the housing inventory remains low. All of this is putting pressure on consumers. So the question is, what we're seeing now, is it something that is going to continue in the long run, and how sustainable this pattern of behavior is?
So, but you do expect continued rate cuts in that case?
Absolutely. I think that the Fed rate cut that we saw happen in the positive markets, which is something that Fed did somewhat preemptively, and we absolutely are expecting that the rate cuts would continue. What seems to be priced in is 5 to 6 rate cuts, about 150 basis points all in over the next 12 months. But we know that this is an extremely data-driven Fed, and the big point to pay attention to is that the CPI has not been coming down quite as quickly as expected. So is 2% number a really realistic expectation, or perhaps we're going to be in the higher inflationary environment for longer, which is going to be a big change for this market and for the consumer.
And Katerina, let's talk a little bit more about the consumer and, of course, how those rate cuts filter in through the different income tiers. Because, for example, we're speaking to the CEO of JCPenney in the next block, and that sort of caters to that middle-class consumer, that lower-tier consumer. And you think about who needs rate cuts in this environment. How do you expect that to actually ripple through the economy?
Well, absolutely. And Sonali, that we are looking at the rate cuts as this magic solution and something that is going to immediately affect the economy. But the truth is that there is a time frame and the time element that just takes place, and that's a normal expectation. So it will be a while until it actually, makes its way down to the consumer level and they can feel the benefit. And until that point, market is completely discounting the possibility that inflation will remain at the elevated levels. Market seems to be discounting a lot of things: the political uncertainty, the geopolitical uncertainty, the fact that we have this environment where we keep hitting the new highs that are supported by positive earnings, but but it really is the positive earnings momentum and the margins that will have to be quite expanded in order for these ambitious expectations to be met. So this is a positive environment for the market.
It's interesting. A little earlier this week, I had a conversation with Apollo CEO Marc, and he had a very similar comment as you, where the market is not baking in a lot of risk. And he says for that reason, he's risk off at this moment until prices come down. Do you share that view? And if you do, where do prices really need to be for you to be comfortable to participate more in this market?
Well, what we see right now is the uptick in the market, and of course, with that, positive performance in the cyclicals. But with that, we think that it might be a good time to take some profits in the defensives, but by no means to abandon the defensive stance and the defensive positioning in the sectors like financials, healthcare, industrials, energy. All of that is really important. The dividend income component in the portfolio is important. But the question here is that there is also the safe haven that despite of the rate cuts, real rates remained high, and we can still earn about 5% in the investment grade corporate fixed income. And what investors are starting to question is, can they really expect market being at such high levels to earn over 5% over the next 12 months? So this is the time where diversification is probably more important than ever,
Katerina,
not only within sectors here, but internationally.
You know, one sector in particular, I'm interested to marinate on financials for a little more, because after we saw those blowout earnings from all the big banks, you are now getting a lot of choppiness as we head into the rest of the earnings season for the financials. The credit card companies really feeling a little pain today. You're seeing the regional banks feeling pain as well. How much sensitivity is there still when you look at the financials to a potentially weaker economy?
It's a great question. We like the financials, we like the positioning of the sector, but to your point, not all financial sectors, not all positions within financial sector are created equal. And this is a great time for the bottom-up stock picking, and we have to really actively manage expectations and look at the positioning of the companies, because of the higher interest rate environment and the concerns that we have seen some weakness in the within the credit card companies and some of the defaults that are starting to come in. And the higher interest rate environment on one side is very profitable for certain financial sectors, but it also raises concerns, over the stability of some of the regional banks and credit card companies.
Certainly a lot to look out for this earnings season. Katerina Simonetti of Morgan Stanley, we thank you so very much. Happy Friday. Happy weekend to you. Now, coming up, we're going to talk more about that consumer. Holiday shopping season is gearing up. I hear there's already Christmas stuff at stores. I think that's crazy. Anyways, JCPenney has a new strategy aimed at budget-conscious consumers. The company's CEO, Marc Rosen, joins us next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. The fallout from Nomura's market manipulation scandal is spreading. Some of Japan's biggest financial institutions have halted securities trading with the Japanese bank, including major life insurers, banks, and asset management firms. Authorities said last month that an unidentified employee at Nomura manipulated government bond futures in 2021 by placing big orders without intending to buy or sell all of them. CVS has named David Joyner as its new CEO, ousting Carol Lynch after a tumultuous term as the boss at the pharma giant. Joyner, a longtime exec at the company, has taken over the job effective immediately. CVS said it's expecting to miss Wall Street estimates in the third quarter and that it will put 2024 guidance away because of elevated medical costs. And Ray Dalio thinks there's a good chance that the result of next month's election will be contested. Speaking at the Future China Global Forum in Singapore, the former head of Bridgewater thinks even the fact that he and others are talking about the chances of a contested result underscores the uncertainty in the U.S. Katie?
All right, let's turn back to retail now. In the state of the consumer, let's talk about JCPenney. Of course, the retailer is unveiling a new pricing strategy that aims to ensure that no budget is too small, Joining us now with more on the state of the U.S. consumer is JCPenney CEO Marc Rosen. Marc, it's great to have you back with us. And let's talk about that. We were just having a conversation with Katerina, Simonetti, of course, about who needs rate cuts in this economy. And the answer increasingly, of course, is that middle-class consumer. It's that lower-tier consumer. And with that in mind, what do your promotionals and your sales look like heading into the holiday season?
Well, that's right. I mean, I think as you look at the economy right now, certainly the consumer is pressed a bit right now. And we do say that our customer, which is really America's diverse working families, it's that middle-class consumer, it's that working family, it's the teachers that teach our kids, it's the medical workers that take care of us and our family, and the construction workers that build our homes. And they are stretched right now. But we're actually really encouraged with what we've seen really since back to school. So we saw a step change improvement in traffic and sales in back to school. And then I know you were just rolling the tape from our really big deals, which air every Thursday night on Thursday Night Football. And we've been really encouraged with what we're seeing with that, too. In fact, we've now seen where we expect that during the holiday, we're going to have from that Thursday Night Football over 2 million new customers who are in our file by that time. And so the customer is looking for value, but they're also looking for joy. And they're going to celebrate and they're going to have holiday, and we're confident about that.
Right. And of course, October 18th, as Sonali was pointing out, we're already in Christmas decorating season here. But I am curious. I mean, when you think about JCPenney, of course, you've been around for a long, long time. You're an iconic brand that has fallen on some hard times. How do you balance, of course, promotions, putting through discounts, while still trying to build brand relevancy and brand value? I have to imagine that's a difficult needle to thread.
Right. So as you mentioned, right, JCPenney has been around for over 120 years. And throughout that time, we've always stood for value to the consumer. And so value is a really important part of our proposition. But value is about more than just promotion and price. Value is about being able to find the fashion statements that you want. So for holiday, we're introducing, I think one of my favorite items is a bear paw blanket, right? Really comfy, really great item. It's going to be in our stores. It's at a great price, and you can find that for holiday. I think, when we talk about value also, it's not just meaning low price. So one of the biggest items for women this holiday, we're expecting to be diamonds. And we have a great jewelry department that sells those diamonds at a great price and a great value for what you're getting. But the consumer's interested in buying those items. So for us, really, the brand value proposition is about accessible fashion. It's about finding great value, which is quality and brands at a really outstanding price. And it's about a great shopping experience. And it's that combination that's going to win.
It's interesting. You're clearly making a lot of inventory choices at this moment based on changing consumer preferences. I'm wondering, Marc, in the other direction, are there things that you seem to be buying a lot less of these days, given where consumer preferences are headed?
Yeah, I think as we look at holiday, we're really focused on what we're buying and making sure that we have the right inventory. And a lot of our, we announced about a year ago, $1 billion self-funded reinvestment in the business. A big part of that was in inventory tools and making sure that we're getting the right items in the right place for the customer. So we're certainly focused on some of the big items that we know we're going to have. Our St. John's Bay cable knit sweater is always a bestseller. But we are also focused on what are some of the items that are not selling as well, and how do we make sure we can invest that inventory in the things that are going to drive sales growth.
What is the main cohort you're going after? I mean, it's been said middle class. Certainly that was the case when I was a kid in Central Ohio, but that was a long time ago. Who is your customer, and how is that customer doing right now?
Yeah, our customer, we say our customer is really the core of America. It is America's diverse working families. So as I said earlier, it really is the teachers that are teaching our kids. It's construction workers that are building our homes and offices. It's the medical workers taking care of us and our families. And it is that core of America household that we're serving with all the things that they can do. So whether that's towels for their home, whether that's sheets, whether that is clothing, or whether that's holiday gifts. And we're really excited this year. We've expanded our holiday gift selection, but it's everything to serve the needs of that family.
What about your workers? Who is working for you, and how difficult or easy is it for you to find employees to fully staff a store? Because frankly, for me at least, the retail experience, not JCPenney, but most stores, has been really disappointing the last few years. It doesn't seem like there are enough people working there. They don't seem to be really happy with their job. They're not super helpful to customers. So how are you dealing with that?
Right. So I think for us, one of the interesting things is our employees, and when we centered ourselves around our purpose of serving America's diverse working families, that's really our employee also. Our employee mirrors our customer. And so we have operated for over 120 years on the golden rule, which is letting others have the experience and treating others the way that we want to be treated. And that's the guideline of our customer service in stores. We've been encouraged with staffing for this holiday and really over the last probably 12 plus months as we look at the labor market, that both in our stores and our distribution centers we've been able to hire. We also have a lot of long tenured associates in our stores. And we're really focused on Net Promoter Score, and we've seen a big increase in Net Promoter Score as we've remodeled our stores and as we've really focused on the service initiative within stores.
And I'm taking a look at some recent headlines. In September, the news came out that you plan to hire more than 10,000 seasonal workers for this upcoming holiday season. How does that compare to years past, Marc?
It's really a similar trend to years past, so not a big difference this year. I think we're expecting a strong holiday season, and we're staffing up for that holiday season, and we're hiring accordingly.
All right, Marc, really appreciate the update. Have a great weekend when you get there. That is JCPenney CEO Marc Rosen. Now, coming up, both presidential candidates are on their way to Michigan as we enter the home stretch of the campaign. We'll take a look at the weekend ahead for Trump and Harris next. This is Bloomberg.
Just 18 days away from the presidential election as the candidates enter the home stretch of their campaigns. Both Donald Trump and Kamala Harris are headed to Michigan today. It's a crucial swing state on the race to the White House. Bloomberg's Balance of Power co-host Joe Matthew is with us now to talk about what to expect. And I'm sure we'll get to the Al Smith dinner at some point because it was funny and also cringeworthy at some points. But Michigan is key.
Yeah, awkward.
Yes, exactly. Michigan is key, especially I go often to Michigan. I go to Dearborn because Ford is there, and there are so many Muslim Americans working there. It's a huge hub for those who have come from that part of the world. Do we know in any way how they're going to vote? I mean, both of these candidates are pro-Israel, so does that have anything to do with it?
You're going right for the fastball here, Matt, and the answer is no. This is one of the things we'll be looking back on when we do our armchair quarterbacking after the fact. Everything will seem obvious in hindsight, but the fact of the matter is the Harris campaign can't really measure that as much as just being there on the ground and talking to people and trying to deliver the message that most recently has been, as we heard in the Fox News interview this week, I am not a rubber stamp for Joe Biden. I'm not going to be another Joe Biden term. I am my own person. But, of course, to your point, Matt, we saw Kamala Harris speaking for the administration yesterday following the Sinwar death announcement. Joe Biden was in the air on his way to Germany, and she was, in fact, the voice of the administration. So it's kind of hard to find sunlight there on some of these issues. She'll be, by the way, headed to Lansing to a GM plant, Matt, you're probably familiar with. They've got a $500 million grant from the IRA to convert that from an ICE plant to an EV plant. And she's going to call out Donald Trump when she gets there for trying to undo the IRA.
Speaking of call-outs, because you guys teased this so wonderfully, let's talk about that dinner last night. Let's first, Joe, take a listen to what Trump had to say at that Al Smith dinner.
Kamala now sees the benefit of deportation. She wants to deport people. She's vicious. She wants to deport people, and she wants to start by deporting Brett Baer, Fox. I'm supposed to tell a few self-deprecating jokes this evening, so here it goes. Nope, I've got nothing. Jim Gaffigan, most recently, Jim has been playing Tim Walsh on Saturday Night Live, and that'll be a very short gig, I hope. But unfortunately, Governor Walsh isn't here himself, but don't worry, he'll say that he was. The mayor's dietary restrictions are well known, but I've got to say, I've never met a person who's a vegan who liked turkey so much.
It was supposed to be a roast, but it got quite scathing at some points.
The delivery was not good, right? No. That's not comedic delivery. He's much funnier unscripted.
Yeah, he left it to Jim got to go for a few rounds at the Comedy Cellar, you know.
Anyways, Joe, what did you make of last night? Of course, Vice President Harris was not there, but where is this all going?
Well, she sent in a video. I don't know if you saw this. of all people, Molly Smith, the Saturday Night Live, Mary Catherine Gallagher, Molly Shannon, I should say, playing Mary Catherine Gallagher, the Catholic schoolgirl making fun of Catholic schools, kind of a strange crowd for that. There wasn't a lot of clapping or laughing while that was being played, just like when Donald Trump was talking. But look, this is supposed to be a lighthearted affair. We've been doing this for a long time. And Donald Trump got pretty tough. He's calling out Kamala Harris and her level of intelligence. She, called out her husband for having an affair and Tim Walz for not being a real man. Look, he's leading Kamala Harris among Catholic voters. I don't know if last night makes any difference, but he did point out, and it's true, the last time a presidential candidate skipped that dinner was Walter Mondale in 1984.
He also pointed out that this stuff was written for him, and he didn't think it was very good material. In fact, he said it was pretty rough material, didn't he?
I guess that's one way to hedge yourself if, of course...
He said they didn't want him to use the teleprompter, and so he's looking down at the notes. But to your point, Matt, he does this pretty well, actually. He'll do 2 hours practically, on an average weekend and get the place laughing. So it might have just been a strange environment for him.
It certainly felt like a strange environment. Maybe the fact that he didn't have a teleprompter, of course, impacted the delivery there. Joe, just quickly in 30 seconds, there was a really fascinating story in the Wall Street Journal about Polymarket. The Wall Street Journal reporting that basically this big surge that Donald Trump saw maybe could be tied back to 4 accounts. You've been doing this for a long time, of course. You've been following the polls, but betting markets, I mean, some people have been using these as gospel.
That's true, and it does remind us that there's a reason why we have sample sizes in polling, when you can have an individual make a massive bet that skews the poly market in one direction or another. If Donald Trump does not win this election, though, expect him to point back to these numbers to call into question the final result.
All right, Joe Matthew joining us with the latest in Washington. Thank you. Coming up, Fifth Third reporting third quarter results in line with expectations. We'll break down the quarter with Tim Spence, Fifth Third Chairman, CEO, and President next. This is Bloomberg.
All of those things. So many titles.
Now, one stock we're watching this morning, Fifth Third Bancorp, the company meeting deposit expectations in the third quarter as it focuses on stability. The bank is also keeping its focus on expanding to the southeastern United States. Joining us now is Tim Spence, Fifth Third Bancorp Chairman, CEO, and President. And, a lot of investors have their eye on your market right now. Things seem to be improving and holding stable in terms of the net interest income you're bringing in, but you're also looking to expand. You're looking to grow at this point in time. According to Bloomberg's own estimates, the expense ratio just a little bit more than expectations. How do you, Tim, set expectations for investors on the growth rate you're putting forward?
Sure. And Sonali, thank you for having me on this morning. I've been looking forward to chatting with you folks. I think from my point of view, the way that you run a really great regional bank through the cycle is you focus on stability, profitability, and growth in that order. So last year was an important proving ground with the challenges in liquidity that faced so much of the sector. Fifth Third had a very good run in that regard. I think we grew deposits by 5% year over year, and the industry was down 3%. The profitability's remained really strong. We have the highest ROE of any of the banks that have reported thus far, at least in our investor peer group. And it's been the most stable over the course of the past year. And the byproduct of that then is you get to focus on growth. I think we have tried to be really diligent about maintaining consistent expense growth. It's been the lowest of any of our investor peers over the last 5 years on an organic basis. But during that time, we also been making big investments in the franchise, principally in the expansion into the Southeast, the investments that we continue to make in our commercial payments platform, and then our own internal technology projects. And those things are important. You have to do them over time because in a market that is as competitive as the U.S. banking system is, building a competitive moat's a little bit like digging a hole in sand. If you stop digging, it fills in a little bit. So we will continue to be focused on making investments and strengthening the customer value proposition, expanding the reach, and ensuring that as we enter into what I think may be a pretty favorable environment for banks next year, that we are positioned to benefit from the growth.
I want to go back to what you were saying about that southeastern expansion, guys. This is a Cincinnati, Ohio-based bank, and
I know it.
I know Matt loves Ohio, of course. From Ohio,
of course.
So, I know we got a fellow Ohioan.
Exactly.
Fellow Ohioan.
So that Southeast expansion, I'm really curious about how you go about it. Is this a matter of investing in different branches and more people, or do you see yourself making an acquisition at any point in time as you make your expansion across the U.S. a little more?
Sure. The focus for Fifth Third really has been on building out existing markets organically. We entered the Southeast in South Florida, specifically as far back as 30 years ago. And then the bank did make a series of acquisitions in the early 2000s that provided the initial entry point in the platform. But all of the growth that we have benefited from over the course of the past few years has come from organic investments, either in building out our retail branch network or in the hiring of experienced middle market banking and wealth management teams to ensure that we had the full complement of businesses. So we have built the second most branches in the Southeast over the course of the past 5 years and have then been able to benefit from that, in particular in an environment where raising deposits was important. The FDIC releases a summary of deposits once a year in the third quarter. That gives us kind of a view market by market into how we're doing. And we grew deposits in the Southeast by 16% last year and gained market share in 14 of the 15 MSAs where we compete. So I feel really good about our ability to continue to grow in those markets, achieve the top 5 share position that we have targeted on an organic basis.
Well, let's keep talking about the Southeast, because you highlight in your notes that you plan to accelerate your new branch openings so that by 2028, nearly half of your network will be in the Southeast. So some big plans there. Can we talk about why? What do you see in the Southeast?
Yeah, I think the thing that everybody sees in the Southeast has been the big demographic migration that many of the mid-sized markets in the Southeast have benefited from over a period of about the last 10 or 15 years. The pandemic certainly accelerated the growth in some of the markets, but even if you take the pandemic out, the Southeast mid-sized metro areas were growing at a rate at, call it 2 to 5 times the rate of U.S. population. And the other reason that we like this sort of 50-50 mix is that I think a global financial crisis and then a global health pandemic caused people to forget that historically economic pullbacks, recessions were really regional phenomenon. And we think there's a real benefit to having a 50-50 multi-regional split, just in terms of our ability to continue to drive diversification into the business. And therefore a more stable, consistent return profile through the cycle.
All right, I want to ask about, your customers, the business that you're dealing with, because we talk about the U.S. economy as a monolith all the time, 3% GDP, adding, 250,000 jobs, 3% inflation at the core. But obviously, it's going to be different for the people at Skyline Chili, that you're dealing with in Cincinnati every day. So what's your customer profile look like compared to sort of the median that we talk about here in New York all the time?
You had me worried there for a minute, Matt, that you were going to ask me to comment on the Skyline Chili Grater's ice cream collaboration.
Delicious.
Yeah. I'd had to no comment on that one. Yeah, look, I think the economy is a little bit uneven right now. Maybe I'll start on the consumer side and then I'll hit businesses. If you look at the consumer population, and we really are a super prime lender in consumer, but we bank the full spectrum in terms of financial circumstances in our deposit business. Folks who had assets and who owned their homes going into the pandemic are benefiting from really a historically favorable environment. Their wage growth has been pretty good. All asset values have performed well. They locked in fixed rate mortgages at a 2.5% to 3% interest rate. And the byproduct of that is they continue to run at a level, if you just look at the liquidity they have available, that's well above, and to spend for that matter, at a level that's well above what the historical trend would be. If, on the other hand, you look at the bottom quartile of the population in terms of income, more likely to rent than they are to own. They're experiencing still pretty significant hardships, right? Inflation hit those folks hard, not just because you were talking about the increased cost of buying or insuring a car, but you had rental inflation, which is the single largest expense that they face on a monthly basis, and then the run up in food prices. And they have not kept up. In fact, the bottom quartile of the consumer population in terms of income is like 20% below pre-pandemic levels in terms of the balance they carry in their checking account month to month. So they're tight. I think the same dynamic has materialized in businesses. More interest rate sensitive sectors like real estate have been challenged over the course of the past couple of years. More indebted companies have been challenged. Companies that didn't have control over their supply chain or didn't have enough scale in their markets where they were able to pass on increases in costs, whether they were labor or otherwise, have continued to struggle in terms of their ability to rebound. The good news is when you look at our footprint, we principally bank people who make things or who move things or distribute things. We have the lowest share of commercial real estate relative to total loans of any of the banks our size. We don't have an outsized mortgage portfolio. And the byproduct of that is, they have done pretty well. And in fact, in many cases, have actually benefited from the industrial policy here that's focused on more domestic manufacturing, more energy independence and otherwise.
All right, Tim, thanks so much for joining us. Tim Spence there, coming to us from Cincinnati and Fifth Third Bank. By the way, Graeter's is probably the best ice cream brand in America, out of Ohio. And apparently they were considering a Skyline chili flavor.
That's disgusting.
So a chili flavored
does it have like chunks of meat in it?
Yeah, I would hope so.
Pinto
beans.
Ice cream.
Not into that.
All right.
Let's get over to Bloomberg's Abigail Doolittle. She's got a check on the markets for us. Abby?
Well, we're looking at a 6-up week in a row for the S&P 500. That's the longest winning streak for this broad index of the year, up about 0.7% on the week. Now, interesting, crude oil, which is also a risk asset, not confirming that move, but it could be that the move down in oil helping the S&P 500 because, of course, that's an inflation tell. In terms of crude oil, a few different things going on there. Of course, the war in Ukraine, the Middle East conflict, and then China, demand in China, perhaps fear of more tariffs on China. It could be the demand in China that is dragging the most in some ways. The 10-year yield, a small move lower, and then the euro dollar after the ECB cut by 25 basis points, a third cut in a row as expected, weighing on the euro. Relative to earnings, this is a pretty good earnings season so far, even though it's interesting because the growth for this earnings season is expected to be 3.8% on the bottom line. I think that's the bottom line. That is one of the slower growth periods that we've seen recently. So sort of a mediocre quarter from that standpoint, but it's a great quarter relative to the performance of stocks that do meet or beat their estimates. Similar to the second quarter, stocks are being rewarded the next day by 1.7%. Let's take a look at some of those stocks on the day, both the upside and the downside. Netflix up a very healthy 10% after they beat the quarter. Subscribers, importantly, coming in well above the estimate, above 5 million subscribers. Apple up 1.2%, some positive chatter around the iPhone 16 relative to China demand. American Express falling, and this is that bifurcated consumer. They brought their growth range down to 9% from 9 to 11%. The CEO saying that there's some demand and billings issues. And then CVS, well, CVS in a world of hurt, down 8.8%. A new CEO, lots of difficult trends there. Investors not liking that at all, Katie.
A world of hurt for CVS. I think that's fair to say, of course. It's your biggest loser in the S&P 500 right now. Abigail Doolittle, thank you so much. Now, up next, a story about addressing global needs. The president of the Rockefeller Foundation discusses the organization's efforts to bring electricity to 300 million Africans. That's next. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. Nearly 600 million people in sub-Saharan Africa are currently living without electricity. David Weston speaks with Rockefeller Foundation President Shah about the organization's partnership with the World Bank to bring clean and sustainable power to 300 million Africans.
The Rockefeller Foundation, together with our partners, have launched with the World Bank and others a large-scale public-private partnership to try to bring innovation, technology, and new types of financing to reach 300 million people in Africa with renewable electricity, for example.
Innovation and technology. What about speed? Because there are a lot of criticisms of the World Bank and other multilateral development banks that, in fact, things take too long.
Well, they do. They do take way too long. And if you look at how long it took the country of Zambia to restructure its crushing debt burdens, it took many, many years and 17 rounds of negotiations, and it is seen as largely inadequate. That's why our program, Mission 300, is, I think, a shining example of what could go right. We've set a target that by 2030, we will reach 300 million people with renewable electricity. We've motivated the banks to provide real money. The World Bank and the African Development Bank together have committed $30 billion to this task. Capital they have and can deploy against this task if countries agree. And we're mobilizing the 15 countries that are leading this effort in Africa will all be present in Tanzania at the end of January, signing compacts that commit their resources, their policy reforms, and their anti-corruption efforts to make this possible. And that's really a unique public-private partnership. It takes all partners. It has a deadline, and we have to get it right because we have to show that you can actually deliver results in a timely way.
Raj, where do those numbers come from? 2030 and 300 million. Those are very, very big numbers in a very short period of time. Did somebody actually figure out that is doable and we can do it, or is that just a target out there?
Oh, absolutely, it's doable. So there's 600 million people in Africa with no real productive access to electricity. Of that number, almost a third of that is in Nigeria alone. And so when we look at Mission 300, which is what we call this effort, and we break the targets down by the 15 countries that account for sort of 70% of the total target, a huge share of that is Nigeria alone, which is where the program has already started, is already underway, and is already aiming to reach about 19, 20 million people. It's a matter of scaling up a successful application of technology and finance.
There's a lot of scale up involved, though. I mean, there are some projects, as I understand, that have begun, but they're relatively modest in size. Is that not right?
You know, they're modest in size, although they're pretty significant in numbers. I mean, we have thousands of new renewable mini grids coming online in Nigeria. These grids tend to be connected to the larger grid system, but they provide the opportunity for new entrepreneurial enterprises to build out energy infrastructure, to service communities, to find customers, to collect revenue, and to become sustainable. And we've seen that model work in India. We've seen it work in Latin America. We're now seeing it applied at scale in Africa. Now, it's not easy. And as you point out, it requires a significant public subsidy, about 30, 35%. But that's why the funding from the World Bank and the African Development Bank are so critical to success.
That was Rajiv Shah of the Rockefeller Foundation. David Weston joins us now, and another Wall Street week kicks off tonight at 6 p.m. What have you got in store for us?
Well, we're going to have a story on this subject, but the subject is the huge need you hear about there. At the same time, how fast is that need getting met as we're looking toward World Bank and IMF meetings next week? Some people think that the World Bank's moving too slowly. Ajay Banga is obviously the new head of that, and he says they need to get bigger and they get faster. And the question is, are they? But we also go into nuclear energy, large need for energy, particularly for that electricity for AI, and really shift in attitudes toward nuclear. And also we deal with immigration. Since we're having an election, we thought we'd deal with immigration. And ironically, in North Dakota, they have a state office for immigration. They've got a state office to attract immigrants. They advertise for immigrants to come to North Carolina because they need, to North Dakota because they need the workers.
I hope they put the office in Texas, right? Or Arizona. I feel like there's a place where they can get a lot of immigrants.
David, you have some great statistics that come out of that North Dakota story. I mean, it's a really positive story. How does it differ from what else?
Well, it's 30,000 workers there short in North Dakota right now, and that's why they're really campaigning to get people to come. And this includes, obviously, legal immigrants, also people who are here seeking asylum. When they're pending asylum, when they have their work permits, they're welcome as well. And particularly in certain areas like nursing, for example. They have a huge need for nurses there. And we talked with a fairly sophisticated glass manufacturing facility in Fargo, and the plant manager there, and he told us that 70% of their employees are immigrants. And by the way, they do all sorts of training for these new employees in multiple languages because they don't even speak English.
Yeah, so a positive story there. And it's interesting to hear the types of jobs, of course, that these immigrants are suited for. And before we go, I mean, I'm glad that you're doing nuclear again. It just feels like there's so much to say about that industry at this moment, of course. Feels like an industry that's been waiting for a catalyst, and now we have one.
Well, and almost every day we hear about one of the hyperscalers going into small modular nuclear reactors and going into, quite apart from the 3 Mile Island story, which is quite a story. So if we're going to get done the deal that we need to get done in AI, I think we're going to have to go nuclear to some extent.
Go nuclear.
Yeah.
You could make a pun about it.
Yeah.
All right,
No,
David
you're
Weston.
better at that than I am.
I don't know about that. David Weston, always great to see you, of course. And you can catch Wall Street Week every Friday, including this Friday at 6 p.m. Eastern. This is Bloomberg. Do you want to go long MicroStrategy while also shorting JP Morgan? Or you could pit Alphabet against Comcast, rather. Theoretically, you can if these ETFs launch, because we got some really interesting filings this week out of battle shares. Let's try to break it down with Eric Balchunas. He is Bloomberg Intelligence's senior ETF analyst. And Eric, this is a new type of ETF. Of course, we have single stock ETFs. Now we have these pair trade ETFs, if you want to call them that.
Yeah, no, we predicted a couple of years ago, the more that low-cost passive grows in the core of portfolios, the crazier ETF launches will get, because people are looking to have a little fun with 10, 15% of their account while they wait for the boring stuff to grow. So I don't know if these will succeed or not, but I get it. You know, the 2 times NVIDIA ETF has $5 billion. And that's going to be a magnet for people to try all kinds of fun and games. So these are interesting in that they're trying to play a trend. And they're 180 long and 80 short. So you do get a little extra long bias in there, which I think is smart. I think the Jim Cramer ETF was flawed because it was equal long short. So every day it almost canceled out.
Yeah.
I think you have to pick a long bias here. So, we'll see if people respond to these. Again, if a lot of people don't really know how to short a stock. So if these do something for you, a little legwork, it's been proven that if you make something even a little bit more convenient, you can get some assets in ETFs.
Yeah, of course. The mechanics of these ETFs, the construction, really interesting when you think about the different leverage ratios. I want to talk about some of the stocks that we're talking about because, okay, Tesla versus Ford, that makes sense. I mean, when you start talking about Coinbase versus Wells Fargo or MicroStrategy versus JP Morgan, it's a little kooky, Eric.
Well, remember that the 2x MicroStrategy and the 1.75x MicroStrategy already have like $1 billion combined after like a month on the market. So clearly anything MicroStrategy, I think, will attract a crowd. So, and I saw some of the Bitcoiners on Twitter kind of rejoicing that it was Michael Saylor versus Jamie Dimon in this trade. So I think some of these are playful, but these are all highly late traded stocks. You've got NVIDIA in there and Tesla. Those are the top two most liquid stocks. It's shown if you make ways to gamble around already high volume stocks, you can maybe find an audience. So a lot of these are playing trend. They're playful. There were ETFs like this tried back in the day by Direction, but they try to do like long value, short growth, or long small caps, short large caps. And those didn't catch on. They failed.
Really quickly here, are retail investors just in search of a ton of leverage at this point in time? Because in addition to these, plus a lot of the ones Katie has written about, and just in 30 seconds here, a lot of them are saying, let's do this with some juice.
Yeah, look, we call it packaged adrenaline. There's definitely a lust and need for hot sauce right now for a variety of reasons. So if you make it volatile, they may come. That's generally what some of the flows have showed us.
All right, Eric, it's always great to speak with you. Joining us from Orlando for some reason, Eric Balchunas from Bloomberg Intelligence. And tune in to ETF IQ every Monday at 12 p.m. Eastern. Meanwhile, let's get a quick check on these markets right now, about 90 minutes into the session. You can see shares a little bit higher, currently up about 0.2%. Big tech leading the way with Netflix rallying hard. Big tech currently up about 0.5%. A little bit of a bid in the bond market. Have a great weekend when you get there. This was Bloomberg's Open Interest, and this is Bloomberg.